A woman's signature appears on multiple mortgage documents as a vice president from 20 different banks at the same time. And yet, she never worked a day for any of those banks. Her name is Linda Green, and surprisingly, she doesn't even real I. She was a character invented by a company that existed for one specific reason, that is, to manufacture a fake legal ownership of the homes in America, the company called DocX. However, they made millions of dollars while doing it. That's until a single mom from Florida outsmarts her own bank that later became one of the largest False Claims Act whistleblowers in American history. Her name was Lynn Szymoniak. And because of what she did, it ended up costing 4 of the largest banks in America $95 million fine, while she received a millions of dollars share from what she did as an incentives. The documents sit in county courthouses across the country, filed in foreclosure cases that span more than a decade. Therefore, each of the signature varies. On one page, it is a neat cursive loop. Sometimes it is a hurried scrawl, and the next, just a simple initial. All those claims belong to the same person, which appoint her as an officer of a major financial institution. However, here is the exact detail about the documents. In Massachusetts, Linda Green appears as vice president of American Home Mortgage Servicing. Meanwhile, in Florida, she was a vice president of Wells Fargo. But then in Michigan, she was a vice president of Deutsche Bank. And finally, in Georgia, there's another story. She's become the vice president, Bank of America. Therefore, the titles shift from county to county, but the name remains the same. But the banks was never employed her. She did not even hold an office in any of those institutions, and therefore, she did not authorize the transfer of the loans that bear her name. But it's just the tip of the iceberg. Things will get much darker. The investigators eventually counted her signature on more than 100,000 of documents. The exact total may be far higher than that. Meanwhile, officials in multiple states began pulling court files after a national television expose revealed the scope of the pattern. Surprisingly, the documents were not hidden in vaults. They were sitting in public records, stamped and filed, waiting for someone to reveal the truth. But the question here is not whether the signatures are forged. The question is who exactly forged them. Why every major mortgage servicer in America was willing to accept the forgery as legal proof, and how a single name became the linchpin of a trillion-dollar machinery that moved far faster than the law could follow. It just doesn't make sense at all. And here is where Lynn Szymoniak enters the record. She is an attorney from Florida who had built a practice investigating for an insurance fraud. In July 2008, Deutsche Bank AG sued to foreclose on her home in Palm Beach Gardens because the bank claimed it held the mortgage note and was entitled to seize the property. But here is the part that they didn't see it coming. Szymoniak examined the filing documents with the eye of someone who had spent years looking for inconsistencies in official documents. Meanwhile, the Deutsche Bank stated that it had acquired the loan and was the rightful owner of the property, but the problem here was the actual evidence. The bank could not produce the original mortgage note, and therefore the Deutsche Bank lacked the legal standing to sue her. The case just stalled, but the Deutsche Bank is still returned with a document that did not solve the actual problem. They just make the problem felt undeniable. Apparently, it was an assignment of the mortgage, with the dated on October 2008, purporting to show that the bank had acquired the loan from a prior lender. But instead of solving the actual problem of the missing note, they just created a second document with more serious problem. Deutsche Bank had filed its lawsuit in July 2008, but the assignment showed the bank acquiring the mortgage in October 2008. Therefore, the bank had sued to seize a home that they did not yet own. The contradiction here was not even hidden in a footnote or an appendix. Surprisingly, it appeared in the bank's own filing, presented to the court as proof of ownership. Szymoniak did not just merely notice the chronological impossibility about the document. More than that, she recognized this as a pattern. In other words, the document was not a one-time error made by a careless clerk. That's because the dates were wrong on purpose, by design. The assignment had been manufactured after the fact to cover a gap in the chain of title that the bank could not close through legitimate means. Let's expand this example even further. A single bad document might be a clerical mistake, but the same flaw inside thousands of files consistently, that's just a straight design. Therefore, Szymoniak began to pull records from other foreclosure cases in Florida and across the country, and what she found was quite disturbing. It is the same inconsistency repeated over and over again. Basically, the banks were suing homeowners for loans they could not even prove that they owned it, and then they were producing documents with the dated after the lawsuit had already begun. In other words, the banks were not correcting errors. They tried to inventing ownership. The absurdity about the whole situation here was not that the banks had lost track of the paperwork during the housing boom, it was that they were suing people for homes they could not legally proof, and the courts just casually accepting the claims without even examining the dates. Unfortunately, the homeowner who did not know to look for the discrepancy would lose their house to a bank that had no legal right to take it. That's because the foreclosure machine was running on documents that proved the opposite of what they claimed. But Lynn Szymoniak were not just anybody that they thought she was. She understood what she was looking at because she had seen a fraud before. She did not assume malice where incompetence would suffice. The incompetence does not manufacture a notarized assignments with backdated signatures. Incompetence does not create vice presidents who do not exist, and it does not produce dozens of different signatures for the same person in the same year. In other words, the documents were just too consistent to be accidental, and all the errors leaned in the same direction. Every forgery helped the bank demolish the homeowner. Around the same time in Florida, another attorney named Tom Ice was deposing the bank employees and having them on record admitting they signed hundreds of documents a day without actually reading it. And because of that, Ice is credited with coining the term that would come to define the scandal as the robo-signing. It was a word that made the industrial scale of the forgery legible to a public that had never heard of a lost note affidavit or an allonge, which is the legal rider attached to a note record an endorsement when there is no room left on the original document. Both Ice and Szymoniak were seeing the same machinery from different angles, but neither did they knew is how deep it actually ran. To understand why the documents actually went missing in the first place, it is necessary for you to understand how the mortgages were supposed to work. When a homeowner takes out a mortgage, the lender holds a physical note. But if the lender sells the loan to another bank, the law requires the note to be endorsed by hand and transferred to the new owner. Each of this sale must be recorded in county land records, creating an unbroken chain of title that any court can verify. Although the system is slow, laborious, and expensive, but it is just definitive. During the 1990s and 2000s, the mortgage industry discovered that it could make far more money by bundling thousands of loans into securities and selling them to global investors. That's because the demand for new mortgages was enormous. Loans changed hands happened so rapidly that the physical notes could not possibly keep pace with the volume. By the height of the housing bubble, millions of mortgages were being traded monthly. Therefore, the old system of hand-signed endorsements and county recordings had become a physical impossibility at the scale that the market demanded. To put that into perspective, a single mortgage might pass through a dozen of owners in a single year. Each transfer required a new endorsement, a new recording fee, and a new paper trail stored in a county office. To a point where the volume of the mid-2000s, the administrative burden would have consumed the profit margin on the loans themselves. Therefore, the industry chose the speed over documentation, and the law was treated as an obstacle rather than a foundation. To solve this problem, the industry created a workaround: Mortgage Electronic Registration Systems, or MERS. That designed by the Mortgage Bankers Association as a national electronic database that would track transfers without requiring a new paper record every time a loan was sold. MERS is technically operated through MERS Corp Holdings, Inc., with the MERS name itself serving as the nominee on the mortgage, which is a legal stand-in whose purpose was to eliminate the need for county recording. Although the idea was efficient on paper, but the result was a legal vacuum. And here is the initial loophole that leads to a massive forgery operation. MERS registered the transfers digitally, but the physical notes were often never endorsed. Therefore, the chain of the title that courts required to prove ownership was broken at nearly every step. When the housing market collapsed and banks began foreclosing en masse, they discovered that they had traded legal ownership for digital speed. And because of that, they could not prove in court that they owned the loans they were trying to seize. Unfortunately, the gap between what the law required and what the market had done was not a minor clerical issue. It was a structural failure that affected the documentation of more than 60 million mortgages. The gap here was not really a secret. The banks knew they had stopped maintaining the paper trail. Therefore, what they needed was a way to produce the missing documents quickly enough to keep the foreclosure machine running. In other words, when there is a gap between what the law requires and what is physically possible, a market will emerge to eventually fill that gap. That market would turn out to be a company with one purpose, one product, and more than 1 million clients who never asked for their receipt. The document that Deutsche Bank filed on Szymoniak's case was not unique than any other, because it was just a template. Therefore, Szymoniak began comparing foreclosure filings from multiple different states, different banks, and different years. What she found was completely disturbing. It is exactly the same format, with the same legal language and the same impossible dates repeated consistently across thousands of cases. Basically, the assignments were not drafted by attorneys in separate law firms that are working for separate clients. Surprisingly, they were produced by a single company that specialized in manufacturing legal documents for banks that lacked the paperwork required to prove ownership of the loans they were foreclosing upon. The company was called DocX, LLC. It operated as a subsidiary of Lender Processing Services, which publicly traded company based in Jacksonville, Florida. DocX existed for one specific purpose. It is to create mortgage assignments, allonges, lost note affidavits, and other legal instruments that banks needed to foreclose the homes that they didn't actually possess. Basically, a lost note affidavit is a sworn statement claiming that the original promissory note cannot be located, which is a document that courts may accept in lieu of the actual note. Meanwhile, DocX was producing 1,000 these type of notes for loans where the note was not merely lost, but had never been properly transferred in the first place. However, the documents were prepared in bulk, signed by employees who had no legal authority from the banks that they claimed to represent. And even worse, they were notarized as if they were legitimate instruments of transfer. To put that into perspective, in between 2003 and 2009, DocX actually processed more than 1 million documents with the industrial volume. And because of that, the employees sat at desks and signed paperwork by the hour, basically adopting the titles they had not earned and names they had not been given. Therefore, Linda Green was one of those names. The real Linda Green, if she existed as a single person at all, was a low-level employee who had no role in the banks she supposedly represented. What's even more disturbing was her signature was applied to documents by other hands, creating the appearance of authority where none of those were really existed. And to make things worse, many of the signers included the people who had never even worked in banking at all, yet their names appeared on documents as assistant secretaries and vice presidents of major financial institutions. But fortunately, in November 2012, Lorraine Brown, the former president of DocX, pleaded guilty about the conspiracy to commit mail and wire fraud. She admitted that she had authorized the scheme and directed its operation. Therefore, in 2013, she was sentenced to 5 years in federal prison, and furthermore, she was ordered to pay a fine with the amount of $15,000. Meanwhile, the Justice Department even described her company as having filed more than 1 million fraudulently signed mortgage documents over the course of 6 years. To make things worse, the state prosecutors had also pursued the case of Michigan Attorney General Bill Schuette and Missouri Attorney General Chris Koster, which they both had brought charges against Brown and DocX in their jurisdictions, with Koster filing a 136-count indictment that underscored the breadth of the fraud. Here is the part where things just get more disturbing. The conviction was notable for what it did not include. In other words, Brown was the only executive criminally convicted for a fraud that spanned the largest mortgage servicers in America. And yet, no senior banker at any of the major institutions faced criminal charges. A single subsidiary president took the fall for an entire industry that had normalized the production of false evidence as a cost of doing business. Therefore, the settlement just ended the Justice Department's inquiry into lender processing services, but unfortunately, the parent company still continued to operate, to a point where the scale of the operation transformed the nature of the fraud. Basically, if you make a single forged document, that is considered a crime. But 1 million forged documents produced on an assembly line, that is considered a business model. Although the DocX provided the banks with a cheaper alternative than to reconstructing the actual chain of title, the banks did not merely look the other way around. Therefore, they just purchased the service, which a foreclosure machine had been built to run on speed, and when the paperwork could not keep up, the machine simply created its own fuel. Surprisingly, the documents were just too consistent, rapid, and way too convenient to be genuine. And yet, they were filed in courts across the country as the legal basis for seizing the homes. A homeowner who challenged the assignment was often told that the signature was a matter of form, that the debt was real, and that the details of ownership were completely irrelevant, but the details were actually the most important part. That's because they were the entire legal foundation of the foreclosure, and without the proof of ownership, the bank had no more right to seize the home than a stranger on the street. Deutsche Bank's contradiction in Szymoniak's case was not even subtle. That's because it was documented plainly in the bank's own filing, where the lawsuit was dated July 2008, and yet the assignment purporting to prove ownership was dated October 2008. And because of that, the bank had to sue first and then acquired the loan next. They had initiated legal proceedings to seize a property it did not yet own, and they had submitted the proof of ownership after the fact, as if the timeline did not matter. To make things more simpler, in a functioning judicial system, this chronological impossibility would have ended the case immediately. That's because the court would have noted that the plaintiff lacked standing and therefore dismissed the foreclosure. Unfortunately, the foreclosure courts in 2008 and 2009 were overwhelmed beyond capacity. That's mean thousands of cases were filed weekly, and therefore the judges only had minutes to review each file. To make things worse, the homeowners rarely had attorneys, and even when they did appear, they were often unversed in the technical requirements of chain of title law. Basically, the contradiction slipped through the system, not because it was cleverly hidden, but because nobody was actually looking closely enough to see the flaw. But Szymoniak was different. She actually saw through it. She was not a homeowner who accepted the bank's assertions at face value. That's because she was an attorney who had spent years examining documents for precisely the kinds of inconsistencies that foreclosure courts were missing. Therefore, she easily recognized that the assignment Deutsche Bank had submitted was not a legitimate transfer. Although the notarization was authentic with a genuine stamp and the legitimate paper, but yet the content itself written upon it was entirely false. To put that into perspective, the physical operation of DocX basically amplified the absurdity to a scale that was almost felt surreal. The employees who had never worked in banking were given vice president titles and told to sign documents by the stack. To make things worse, the names that they told to sign were often not even their own name. The notaries who witnessed the signatures did not actually watch them being written. Therefore, the documents were just shipped to law firms, entered into evidence, and used to justify the seizure of properties across the country. Surprisingly, the process itself was not a secret within the mortgage servicing industry. It was basically the standard solution to a documentation crisis that the industry had created for itself through its own velocity. In other words, when the proof is this visible and yet the response is absent, the problem is not a lack of evidence, but a lack of incentive to act. That's because the banks were too large to foreclose it slowly, and the courts were too overwhelmed to examine it carefully, and the worst part is that the homeowners were too vulnerable to fight back these giants corporate, to a point that the gap stepped a single attorney who had the training to spot the flaw and the stubbornness to keep pointing at it flaw until the system could no longer look away. So the question here was never whether the fraud could be proven. That's because the documents spoke for themselves. The question here was whether anyone with authority would care enough to stop the machine. Unfortunately, in 2012, someone finally did it for everyone. The system eventually being looked. In 2012, federal prosecutors intervened in Szymoniak's qui tam lawsuit under the False Claims Act. Fortunately, the law allows a private citizen to sue on behalf of the government when fraud against a federal program is discovered. And to make things better, they can receive a share of any recovery if the case is succeeded. Basically, it is one of the oldest legal mechanisms for turning private knowledge into a public accountability. For examples, the False Claims Act dates to the American Civil War, when the Congress needed a way to expose contractors who were selling defective supplies to the Union Army. So the qui tam provision allowed ordinary citizens to act as private prosecutors, and sharing the government's recovery as an incentive to overcome fear of retaliation. Meanwhile, in Szymoniak's case, the fraud involved false claims submitted to the government for mortgage insurance, which meant that the taxpayers were the victims and the False Claims Act applied directly to it. The Consumer Financial Protection Bureau, or CFPB, which had been created in 2010 in the aftermath of the financial crisis, was also now part of the regulatory landscape overseeing mortgage servicing, even though its role in the settlements was secondary to the Justice Department's direct intervention. Fortunately, the government settled with Bank of America, JP Morgan, Citigroup, Wells Fargo, and Ally Financial for $95 million in fine. Meanwhile, Szymoniak received an $18 million as the whistleblower, and it was one of the largest individual awards ever granted under the False Claims Act. Therefore, the settlement made national headlines. 60 Minutes had already featured her story in an expose that reached millions of viewers. For a moment, it appeared that forensic persistence had beaten institutional at scale, which it is, but the numbers only reveal a slightly part of the truth. The 5 banks that settled were the same institutions that had relied on DocX documents to push foreclosures through the courts. The $95 million penalty settled the government's case was just a cost of doing business. But eventually, we will all learn that what goes around comes around. If you consider the arithmetic of that outcome, Deutsche Bank had sued her in July 2008 without even owning her loan. Therefore, they had to manufacture an assignment dated on October 2008 to cover the gap and filed it in court as a proof of ownership. They proceeded to pursue her home for years, but the result was that the industry that was funding the fraud have to pay $18 million to the woman, which they tried to take her homes. Fortunately, the machine that had processed millions of false documents over the course of 6 years, they had to move fast, run on industrial scale, and treated the law as a cost to be routed around, only to realize that none of that really saved them from the consequence of a single person who knew precisely how to deal with the fraud. Let's extend these examples even further. The broader settlement figures just confirm about the weight of what was uncovered. So the national mortgage settlement reached in 2012 between 49 state attorneys general and the 5 largest servicers had a total of $25 billion. It was the largest consumer financial protection settlement in American history at that time. But the banks have to rewrote their servicing rules, provided relief to distressed borrowers, and paid penalties that would have been unthinkable before the robo-signing scandal forced the issue into the public view. Surprisingly, none of it would have worked without the evidence that Szymoniak had assembled from courthouse records, foreclosure filings, and the one document that Deutsche Bank had filed against her with the wrong date. Eventually, Lorraine Brown, the president of DocX, was convicted and sentenced to the federal prison in 2013. The machine that she had operated had processed more than 1 million fraudulent documents, which they had manufactured vice presidents, invented signatures, and provided false evidence to courts in dozens of states. In the end, the company ceased to exist, although its parent company paid penalties and continued operating, but the product which they had sold, a bulk document forgery as a foreclosure service, was finished. The assembly line that had given Linda Green her 100,000 signatures was shut down. A single attorney examined a single foreclosure filing, noticed a 3-month gap between a lawsuit and the ownership document that the bank had filed to support it, and followed that discrepancy until it unraveled a $1 trillion documentation failure. The banks had calculated that the volume would protect them. that not a single homeowner had the expertise or the resources to trace the pattern at scale. But their calculation was wrong. The one variable they had not accounted for was an insurance fraud attorney who already knew how to read a document for what it was hiding. The system might moved fast, but she moved with carefully. Eventually, she won. Basically, the system that was built to prove ownership became the thing that manufactured it. And when that happened, things will took a massive turn toward these giants corporate with no intention to make things better. But that doesn't mean that they were invincible. Only time will eventually reveal the truth that nobody wouldn't see it coming, just the way a single mom from Palm Beach Garden, Florida outsmart her own bank at their own game. I hope you learned something from this video, because I'm having a good time making this type of content. You can subscribe to see more of this. Like and leave a comment if we deserve more people like Lynn Szymoniak. I will see you in the next video. Thank you very much.